We're just going to wait a minute or two for other people to call in, and then we'll begin. So please bear with us. Okay, we're ready to start. So good afternoon, everybody, and welcome to our webinar on Borrowing from Local Initiative Support Corporation, or as we're more commonly known, LISC. My name is Norman Trepner. I'm a member of the National Underwriting Group, and I'll be moderating our program today. Today's presenters, and I'll ask them to raise their hand, are Connie Mack, Senior Vice President of Lending, Malini Nair, Vice President and Chief Credit Officer for Lending, Alex Dawson, Developer Officer in our LA office, here, she's calling in from LA, and Noam Herbert Prince, National Underwriter in the Lending Group. Before we get started, I'd like to go over a few housekeeping items. First one being, because of the large number of attendees today, your phones will be muted throughout the presentation, but we encourage you to send us questions during the presentation. You can do that through your Q&A button on your screen. We'll try to answer questions during the presentation as well as at the end of the presentation, and answers that we don't get to during the presentation will be sent out in the post-webinar follow-up, and they'll also be available on our website next week. Along with answers to your questions, a recording of today's program and the PowerPoint slides will also be available sometime next week. I would check the middle of the next week. And that's, of course, www.lisc.org. I realize that as the session winds down, people may have to drop off, so let me now mention that following today's session, we'd like you to take a brief survey to give us feedback about the program today, Borrowing from LISC, as well as other programs and sessions that might be of interest to you in the future. Now, I'd like to ask people to take a short two-question poll. The first question is, are you currently a partner with LISC and have a local LISC contact in the field? The second question is, have you borrowed from LISC before? So please take a moment or two. We'll give you a minute to answer the poll. So we've gotten some responses already, and it seems. looking at the monitor close to me, it looks like we have a variety of answers from different responders in different areas. So that's great. I'm happy to see a wide variety of people responding from different areas. People have worked with us before. And whether or not whether you partnered with LISC and borrowed from us in the past, or if this is your first time working with LISC or calling into one of our programs, we hope you'll pick up some useful information about LISC and about our loan programs and products. Now moving on to our agenda. What we plan to do this afternoon is give you an overview to the LISC organization, an overview of our loan products, and a few examples of our project categories. Then we'll take you through the lending process from the early stages when we learn about your project and gather information to underwrite the transaction to approval and loan closing. Also included in this section is information you'll find about the application checklist and some of our due diligence requirements. Then we'll touch upon our post-closing loan monitoring and asset management processes, which would then lead us to our final question and answer and wrap up. So now I'll turn it over to Connie Mack.
Thank you, Norman. I appreciate the introduction. As noted, my name is Connie Mack, and I head up the lending department at LISC. Thank you all for joining today. We were thrilled to see how many new organizations and familiar borrowers had taken the time to sign up to join us today. If you've already heard about this program from a local LISC representative, that's fantastic. And I'm going to give a shout out to Peter Bruton in Houston. I believe he's got all of his borrowers in a conference room joining us over some lunch. So I think maybe some other offices have done that as well, which is a great way to kind of have a question and answer after this session. But if you don't know who your local representative is in your LISC market, please feel free to email us at the end of the session, and we'll make a connection for you. So before we dive into the details of how to borrow from LISC, I thought with the variety of folks who are listening today, I might spend just a couple of sentences on describing what LISC is. We are a community development finance institution. That's not a bank or depository or credit union. We exist to provide loans to underserved communities throughout the country. We are certified through the Community Development Finance Institution Fund at the U.S. Department of Treasury, and they provide us resources through a variety of federal programs. So broadly speaking, our primary mission is community development, and we provide a rich mix of resources to particular markets that we have committed to serve. So that's kind of the big overview. My section is really just kind of an understanding of how LISC is created and how long we've been around, and then we'll go a deeper dive into products and process. So we just celebrated our 40th anniversary. We were established in 1979, and in those 40 years, we've been busy. We've invested more than $20 billion, and that's LISC in our affiliates, and we've leveraged more than $60 billion through other financing institutions and organizations that we partner with. Those resources have created more than 400,000 homes and more than 67 million square feet of commercial, retail, and community space, and we've preserved facilities and provided financing to small businesses, grocery stores, healthcare centers, etc. At fiscal year end 2018, LISC had $323 million in total net assets. And for those who have called in who are potential investors or just generally curious, LISC is S&P rated. We began that process in 2017, and we are rated as AA negative, which is an investment grade rating. So I think that helps the folks who maybe understand S&P ratings more than they do a community development finance institution. So our impact, we've touched on, next slide. We've touched on kind of, what we provide financing, what kind of organizations. So we've created opportunities for people to thrive in our cities. And our primary mission is community development. We've provided resources to build affordable housing, educational facilities, fields and recreational spaces, small businesses, commercial industrial buildings and facilities, and healthy food. We've also supported hundreds of retail, arts, and community projects. So, and we'll get into more detail exactly what categories we finance as we move forward. You might want to know where we work. We work in a lot of communities. So nationally, we have 35 offices in almost every state. And then additionally, through our rural program, we work in 45 states and in 2,100 counties. And LISC has three national affiliates that have evolved as we've grown in our work. The National Equity Fund is a low-income housing tax credit syndicator. They're based in Chicago. And New Market Support Company is a New Market tax credit allocatee, the nation's largest. They're also based in Chicago. And then in the last year, we added a new affiliate, Amito, which provides SBA loans nationally. We can move on. So our products are pretty broad in their scope and breadth. I like to say we do kind of very early stage all the way on to permanent. We can do pre-development lending, and we can do perm, mini perm. We bridge a number of government receivables or tax credits. And we also provide lines of credit, either project-based for some of our housing developers, or working capital in particular criteria where there's kind of a lag in getting your funding that is earned. We also, along with our partner Amito, we do provide small business loans, and the loans that we would do are typically not the ones that would be SBA guaranteed. We would refer SBA eligible loans to our partner Amito. And our project types: community facilities, mixed use, commercial and industrial, as we've said, affordable housing, charter schools, early childhood care as well. And we'll spend a few more minutes kind of talking through the products, the details, the terms, interest rates as we move through this presentation. So, So I'm going to hand off to Noam, who's going to carry you through the details of our lending products.
Great, thank you. So here on the screen, you can see a table with all of our various products. And again, just like Connie mentioned, these products are for early stage investments and all through permanent financing as well. And a lot of them are available for a variety of project types, from housing related to grocery stores to healthcare facilities, et cetera, et cetera. We'll do a little bit, just a moment on each product type, just to tease out some of the differences. For pre-development financing, we can do early stage, for early stage uses and costs associated with your project, up to $1.5 million. Generally, we prefer some sort of collateral, but we can do unsecured pre-development loans up to about $500,000 for some of our stronger partners, especially. Acquisition loans can have a higher dollar amount, up to $8 million, and also are generally secured by the real estate associated with that project. And then construction loans also have a similar dollar amount and a similar timeline as well for all of those pre-development acquisition construction loans. We're looking at 2 up to 3 years for a term. Bridge financing as well has a similar term and a similar dollar amount, although a little bit lower, generally up to $5 million. Those are tied directly to the receivables that are coming from some government agency or tax credit program generally. Lines of credit, like Connie mentioned, generally we see project-based lines of credit that are a strong borrower coming in with multiple projects for pre-development or acquisition uses. Those can be larger amounts, up to $5 million, and up to a 3-year term, with each sort of individual project getting a little bit of a review when it becomes a live project. Again, mini permanent is 5 to 7 years for the term, and the interest rate generally is a little bit higher as well. And permanent financing, we can go up to 15 years at this point, and the interest rate bumps up accordingly as well. Those are repaid from the performance of your project, the cash flow from your project, and generally secured by the project as well, with an LTV up to 90% with a strong project. I think the other thing that I'll highlight on this slide is the fees. We do a 1.5% fee for those loans and legal fees as well. Then we have small business loans sort of off to the side there. They're a little bit different. We can do up to $500,000 for leasehold improvements, equipment purchases, FF&E. The collateral requirements are a little different. You see on the business assets or on equipment. The interest rates are generally a little bit higher, and the fees are just a little bit higher as well, a 3% interest rate. Yes, so we can go to the next slide.
Before we move on, a question did come through, and that question is, are we able to finance homeless shelters?
Yes, we are able to finance homeless shelters. We can do pre-development financing or acquisition for those projects, or also, depending on how the operating dollars come together, maybe permanent or mini permanent financing as well. Construction too, of course. So just another word about our interest rate. We have a policy that we call risk-based pricing. When our loans are approved by credit committee, they get a risk rating. And depending on that risk rating, the interest rate is adjusted accordingly. So for short-term loans, you can have an interest rate of 5% for a very low-risk loan. And as it goes up through the risk ratings from 2 or 3 to 4 or 5, the interest rate will go up accordingly. And similarly, as you go for a longer term on your loans, your interest rate will go up as well. And you can see that on the table to the left. And it's important to note also that we do have some special sources of funding that we can use to blend down the interest rate. And you should connect with your local LISC staff to understand what might be available in your particular market and for your particular project. There's a lot of project-related restrictions or geographic restrictions to those.
Thank you. Before you move on, Noam, we have a few other questions. One is, are the products that you mentioned earlier an option for for-profit entities, in particular pre-development financing, and as well as the other products?
Yes. So we do lend to for-profit entities. We have a couple of additional criteria. We would expect joint several guarantees from the principal owners and 10% equity for the stage of financing that we're participating in from the for-profit entity.
And another question that's come up, another big question is, are we able to fund newly founded community-based organizations?
Possibly. I think is probably the best answer. We will definitely review financial statements and understand your financial situation as part of our underwriting. So it really depends on the strength of your operation and how your staff have expertise or experience with the project you're putting together. There's a couple of different factors, so it's not out of the question, but it's a little bit harder.
Yeah, I would say to take on debt, typically we like to see an organization that's been in existence for 2 years, so you have time to get up and running and stabilize. Most of the organizations we work with start with grant resources or for-profit equity, and I think we're more flexible than many for-profit institutions, but we do recognize that debt is a serious commitment, and we hope you have some time to stabilize before you decide to step on.
I'll ask one other question, and we'll get to some others. We'll move on, and then we'll get to some others at the end. One other question before moving on is, how do opportunity zone credits factor into funding through LISC?
Do you want to take that one?
So LISC has an opportunity zone group who is currently raising resources to help deploy opportunity zone funds into areas that are qualified to participate in opportunity zone investment. I think we're closing our first fund this year. I'm looking over to Courtney and our finance group. And And if you are in an opportunity zone, please do reach out to your local representative. We can work with you to try to find a way to address the need in your market.
Great. So one more note on fees. I think we mentioned this on the previous slide, but we have a closing fee for loans and legal fees depending on the loan type and the project type. And then a documentation fee is collected when we start the closing process, and it's credited to your closing fee. So it's not an additional fee, we'll say it that way. Next slide, please. So these are where LISC funds come from. We borrow money from a lot of different sources that we then lend out to make our loans. We have Courtney Brinker from our Treasury Department here if there are additional questions on this particular set of topics. As you can see from the slide, the majority of our funds come from national banks. We did issue a $100 million general obligation bond a couple of years ago, and that's another large source of our capital that we use to fund these loans. And then in addition, we have funds coming from insurance companies and government agencies, and then also foundations and other institutions.
And we do high net worth private individuals do have the opportunity to invest with as well. And if folks have questions about our financing or how you might be part of it, please feel free to type those in. We do have Courtney Brinker from our finance department who's joined us today to answer any specific questions. So for the next section of our presentation, we're going to go into some specific examples of projects that LISC's financing has supported. And we can start with one in DC. This is a project that Sarah's Circle, a nonprofit, put together. Our involvement was a $550,000 pre-development loan for the project. It was secured by the real estate associated with the project. The overall development was about $14 million, with loan housing tax credit, equity, and city subsidy from the District of Columbia as well. It resulted in 49 units of supportive senior housing. And one of the nice things to note about this project is that the DC LISC office actually helped start the project with some grant funding to Sarah's Circle, which helps them put together the proposal to the city in order to get the opportunity to put this project together and get access to that city subsidy. So we were both involved at the very early stage through that grant and through the pre-development financing. This is Paramount Square is a project with a for-profit borrower that we have in Cincinnati, Ohio. They've done a lot of work in Cincinnati. This particular project is, we made two loans to this project. One is a sort of mini-perm, $2 million mini-perm loan, and another is a roughly $500,000, $600,000 bridge loan for historic tax credits. The overall financing included new market tax credit equity, historic tax credit equity, a subordinate loan. It had a total development cost of $9 million about, resulted in 45,000 square feet of commercial space and 15 residential apartments. It's fully leased up, and the tenants are finishing the build out of some of their space. There's a bank branch and a startup brewery. That's the first African-American owned brewery in all of Cincinnati that's opening up in this particular building. And I would say also, again, LISC was involved very early on with some commercial corridor efforts in this neighborhood, providing safety grants and working with the Community Development Corporation that's been active in this community for a long time. This is a project in Chicago, Mariano's Bronzeville, which resulted in a new grocery store, 75,000 square feet of commercial space for that grocery store. It was a large project, $26 million in total development costs. And LISC was one of the lender partners to make this happen. We participated with some other lenders on a large loan. Our portion was $1.5 million on the construction loan. And we used a federal source of subsidy dollars called HFFI, Healthy Food Financing Initiative, to help bring the interest rate down for this project.
And so, before you move on, and just as a reminder to people, we're getting questions throughout the talk, which is great. We'll address some during the conversation, some at the end of the presentation, and hopefully hit them all. And those that we don't address, we'll send in post Q&A follow-up. But there is one question to what you were saying, Noam, which is, does LISC participate with other lenders, and I think you said yes, banks or CDFIs on project financing, and if so, what are LISC's expectations in terms of position, LTV, and repayment?
Yeah, there's a lot to unpack in that question. I don't know that we'll be able to answer it in full, but if you have a specific example to talk through, reach out to us. Broadly put, though, we definitely do participate with other lenders and CDFIs on project financing. We often do participation loans where partner lenders will buy shares of the loans so that if it's too large for any one lender to take on, or we do side-by-side lending with some of our partner lenders. We have sometimes taken a subordinate position in certain projects, but there's a lot more to discuss with that kind of lending.
And to the question of repayment, we do expect to be repaid.
Okay, you can take this one.
Sure. So for our next slide, I'm going to hand it on to Alex in Los Angeles, who has more familiarity with this particular project.
You have to unmute. Unmute.
Can you guys hear me?
Yes.
Yeah.
Yeah. Alex, we got. Do we have her on mute? There we go.
Yeah, now we can hear you. I know.
Maybe. So for everybody on the line, just a moment, we will have Alex with us shortly.
Can you guys hear me?
Yeah.
Okay, great. All right, so hi everybody, my name is Alex Dawson. I'm a lending program officer out of our Los Angeles office. And just kind of picking up on the last question about participation, this Ingraham Apartments is 120 units that are being developed by a nonprofit partner here in LA. And this is another example where we participated with a fellow CDFI to provide a total of close to $11 million in acquisition and pre-development financing. LISC's portion of that was around $5.4 million. Within the 120 units, they're providing half of that as permanent supportive housing, and the other half at 60% of AMI and below. We were able to go beyond our sort of normal loan to value of 90%, going up to about 130% on this loan by utilizing the Capital Magnet Fund to mitigate the risk on the loan to value. We're also able to achieve a slightly lower interest rate than our standard rates on this by utilizing the Capital Magnet Fund. So let's go to the next slide, and I'm going to walk everyone through kind of what our intake process looks like on a local level when you're working with your program officers across the country. LISC is a nonprofit mission-based lender, and lending is really our core business. Our loans cover every phase of development, as you guys have heard from our previous presenters. And we're committed to working together with our borrowers to get affordable housing and economic development projects done. Each local office may operate a little bit differently when beginning the borrowing process with LISC, but there are many characteristics and processes that remain the same across the LISC footprint that get our projects from initial underwriting to a successful closing. So our lending is also very much relationship-driven and mission-focused, but at the end of the day, it is a loan that we're working on, so we will be looking at the material aspects of the project that you're bringing to us. So a couple of key aspects that I wanted to talk about today and things we look for when we're looking at your project. First and foremost, what are you building and why? Like I mentioned, LISC Lending is place-based and mission-focused. And overall, we're more concerned about the quality of the transaction versus the quantity of transactions. So the why here is very important to us as a mission-based lender. Is the project something that supports your organization's mission? Are you looking to build, for example, a daycare center or a grocery store? why are you looking to do that? These are the types of projects that we can help with, but we really want to kind of understand what is your mission and why are you trying to accomplish what it is that you're trying to accomplish. How will your project benefit a low-income area and residents in a very tangible way? Is the project being developed to serve the needs of low-income or underinvested communities? And what will be used to measure those outcomes? Will the project provide access, for example, to affordable housing, to healthcare, to childcare, to healthy food? These are the aspects of the project we really want to understand. What is the charitable purpose at the end of the day of what you're doing? Also, if we're looking at a business loan, we're looking at different aspects, including what is the mission behind the business. We might consider factors such as, is your business located in a low AMI area? Is it women, minority, or veteran-owned? What products and services are you offering to the community? And is the business paying living wages to its employees? So the second thing to highlight here is the relationship. We both work with very long-time historic partners, and we seek new partnerships. Something that's very important to LISC is making sure that we're developing the field of organizations that are able to do this work. So both historic partnerships and new partners are very important to us. When we're working with both historic and new partners, we're really getting to know the organization where they are now. Things may change in a long-standing partner. We might have a new executive director, new board members. We kind of want to understand what that looks like. And with a new partnership, we really want to know what is your mission, what are you trying to accomplish, and who are the people that make up your organization. And then finally, of course, I mentioned that at the end of the day, this is a financial transaction. So what does the money in and money out look like? How will our money be flowing into the project? And are there other sources that will be coming in at the same time? What stage of funding is your project in? Do you have other financial commitments that will be our takeout source? If not, what is the likelihood of you getting those financial commitments for your project? And repayment source, event, and timing. So kind of related to my last point, we really want to understand what is your timeline, what is the specific event that's going to trigger the repayment. So what gets LISC to yes? I've talked a little bit about the charitable purpose. We really want to make sure that that is clear and compelling, and it's demonstrated through some sort of measurable outcome like deed-restricted AMI, job creation or preservation numbers, children served, low-income children served at a daycare center, that kind of thing. And is the project located in a LISC footprint or low to moderate income area? As Connie mentioned, we have 35 offices across the country, and we also work in many rural communities across the country. So we just want to ensure that the project is within our footprint. Does the loan actually resemble a loan, or does it look more like a grant? The ways in which it looks more like a loan, there's a committed or soon-to-be committed takeout source. There's regular repayment scheduled, and at the end of the day, LISC is going to be repaid. Is collateral available? So as Noah mentioned earlier, we generally look for a first position lien on the project side or an off-site piece of collateral. This is something that you'll definitely be talking through with your local program officer, and something that can be flexible to a point depending on what local subsidy sources might be available, or what national subsidy sources such as this capital magnet that I mentioned earlier. And then finally, momentum. So is your community supportive of the project that you're working on? Is your local council member supportive of the project you're working on? Do you know of road bumps that you might come across in your pre-development, construction, or permanent phases? These are things that we look at because we want to understand what risks there might be to get your project to whether it be construction close or construction completion, and so that we can mitigate those risks appropriately as we're underwriting. And then finally, capacity considerations for your organization. We want to make sure that if you've got a large pipeline of affordable housing development projects you're working on, that you've got the staff support or consultant support to get those projects done, and you've got partnerships developed with, for example, a social service provider that might be coming in to help move your project along. We can jump to the next slide. I believe everyone will be getting a copy of this application checklist. This is how your local program officer might begin to analyze your project. It's really just a jumping off point. Depending on your project, your organization, and a number of factors, everything on this list may or may not be applicable. Additionally, we may be asking for more information depending on, of course, the type of project and what we're discovering about the conditions of your project. But there's a few basic categories: project information and financing, what are you going to build, or what is your business plan, and how is the financing structured. We look for organizational financial information. So how has your organization been performing over the past few years? If you have a real estate portfolio, how is that performing? Are your properties in good shape and covering debt service? There's third-party reports. So in the case where we are seeking collateral on a piece of land or a building, we're going to order an appraisal to confirm that that value is there. We may also want to look at the zoning or a market study to ensure that the conditions are right for your project. And then as far as organizational information, we kind of want to see how your organization is structured, how involved your board is, what your staff capacity looks like, and if there has been any recent changes with staffing, kind of understand what that looks like as well. And then for for-profit borrowers, there'll be some extra considerations, including collecting personal financial statements and credit references. So we can go to the next page, and I'll end with one other project example.
Alex, before you...
Yes. Hello?
Large rural platform, fully staffed, lenders, and the process is very similar. So when you think about the local office and working with the local office, there are also people in the rural group who can help you in the checklisting processes would be similar. So please keep that in mind. Sorry, Alex, to interrupt. Please continue.
Oh, no problem. My computer froze at the same time, so that was good timing. So I'm just ending with one other project example. We closed on a loan to Venice Community Housing earlier this year. It was a $4.4 million acquisition and pre-development loan to the organization that's going to be building 40 units of permanent supportive housing for transition-age youth. The project is also unique in that it's providing 4,800 square feet of nonprofit office space for the social service provider that actually is currently operating on site. They're going to be demolishing most of the building and rebuilding new space there. We also use capital magnet funds on this loan in order to decrease the interest rate. And there was a couple of disbursement milestones built into the project to ensure that they would be receiving the financial takeout commitments that we needed to be able to get repaid. So this is an example where we kind of built milestones in to ensure that they were on track, but at the same time to give them flexibility to utilize the pre-development money they needed to move the project forward. So with that, I'm turning it over to Malini.
Great. Thanks, Alex. I'm going to spend just a few minutes talking about the process of how you work with LISC and the lending process, and also I will touch on some of our underwriting criteria and risk factors that we look at when we underwrite and review and approve loans. So in this slide, you'll see that there's three sets of sort of parties involved in the lending transaction. And one is the borrower, and the borrower basically will reach out to the local contact at LISC, at one of our 35 offices, or the rural point of contact, and really just start the conversation about the type of project, what you're looking for in terms of financing, the stage of financing, and so on. The local staff will then prepare a loan intake, which is a 2-page quick document that outlines the details of the project, some basic financial information, and the source of repayment, things like that. And we'll get some feedback from the national team that sits mostly here in the New York office. After they get the green light to move forward, the local staff will then prepare a credit memo, which gets and do the complete underwriting and prepare the credit memo that then is presented to a national credit committee that meets every week to review loans and approve them. Any loans up to $5 million, the National Credit Committee has the authority to approve them. Anything above $5 million and up to $8 million also has to be reviewed by a subgroup of our board that meets quarterly as well as on an ad hoc basis. And then loans above $8 million are also presented to the full board. After the loan is approved, it moves through the closing process. As a borrower, you will interact with loan closers. You will also interact with our attorney, and then you will also ultimately, once the loan closes and funds, you will be assigned an asset manager who works with you to monitor the progress of your project and gather financials and things like that. But your primary relationship point of contact is your local office staff. It is really their market and their project that they're looking to move forward, and those are the relationships that you continue to maintain as you do more work.
Excuse me, Malini, a question came through. Is there local representation on the loan committee?
So, yes, so the local offices, some of our local offices have a local advisory committee that will review the project. Some of them look at it from a programmatic criteria to see if it fits the mission of, what the local office is trying to do. And sometimes they weigh in on things like loan structure and so on. But there's the credit committee that meets weekly is a national team that comprises of representatives from our legal department, finance department, asset management, financial analysis, as well as credit. In terms of the timeline, from the time you have reached out to your local contact until the loan closes, it's typically a 12-week process. You can expedite that if you can deliver some of the items on that checklist in advance and quickly, and be available to answer questions that the lender might have about the project or the financial information. From loan approval to closing typically takes around 6 days. Okay, next slide. Okay, so I just want to touch on some of the credit criteria that we look at and the underwriting criteria that we look at when we review loans. These are the 5 main categories that feed into our risk rating for loans. So, weaker the project is on various aspects, it risk rates higher. We place a lot of emphasis, as we mentioned, on the repayment event. Even though we do look at collateral, we're not a typical bank-like real estate lender where we are focused on an X amount LTV. We really are trying, most of our projects and most of our loans are early stage financing. So we're really looking to understand what is the project, is there a demand for the housing or the business, and how are we going to get paid. So our risk rating is weighted heavily towards repayment and takeout financing. We then also look at the financial strength of the borrower, your financial ratios, 3 years of historic financials, credit scores, references, any portfolio of real estate that you have and how it's We look at the organizational capacity. So, do you have experience with this type of project or business? Do you have the capacity and the bandwidth to take it on? Do you have the right team in place to execute on the project? And then, what has our relationship been with LISC in the past, working with this organization? Deal structuring, we do look at, ways we can help to get to a higher LTV if that's what the financing is requiring. We do look at debt service coverage ratios, usually 1.15 we require, and then, what does the pro forma of the project show? Is it going to cash flow? Can it repay all the debt on the project? And last but not least, collateral. We do take real estate collateral on most of our loans, but we do look at other forms of collateral as well that includes developer fees, letters of credit. One thing I'll also mention here is we do require guarantees from sponsoring organizations, parent organizations, as well as from the principals of the borrower. And we do analyze the financials of those entities as well.
And before we move on to questions, can you just clarify the timing for the underwriting and approval that you mentioned earlier?
From the time the borrower contacts LISC to the time the loan closes, you can expect around a 12-week time frame. That includes gathering the information to prepare the intake form, which is sort of our triage, to sort of green light the project, very preliminary basic information. The underwriting process can typically take 2 to 4 weeks. We have a credit committee, as I said, every week. The deals get presented very frequently, and then from approval to closing, another 6 to 8 week process.
Thank you. Yeah. And as to one other question, yes, these slides, this deck will be available online next week. So all these slides that you're seeing will be available to you all.
Yeah. Okay. We can go to the next slide. So this is just, how can you expedite that, sort of shorten that 12-week process? I mean, I think this is just to give you a sense of your lender will reach out to you with items that they need to begin the underwriting. I'd say certain typical things are 3 years of financial information, personal financial statements if you're a for-profit borrower, project description, and description of the financing options for the next phase that would take out this loan. Appraisals, environmentals, any third-party reports that we might need, and if you have them handy, giving it to your lender during the underwriting process will really help them get through the underwriting process quickly. I'd also say being available to answer questions, especially if you're a new borrower, there might be some questions around the financials. So being available to answer those questions would really help to move the process quickly. I'd say the approval process is fairly quick, at least because we meet weekly, and then your lender will know what they need to do to get it through sort of the approval in the system and things like that. And then the closing process, again, to the extent you have the diligence items that you will be notified of in the closing checklist, organizational documents, third-party reports, to the extent you have all of those, and you can send them in quickly, that expedites the closing process. We do send out a loan approval notification letter after the loan is approved, and we usually don't engage counsel until we get back the signed loan approval notification letter as well as the documentation fee. So again, if you're looking to close quickly, please do send us those things as soon as you can. You will be assigned a loan closer who's going to work with you to gather information and answer any questions through the closing process. Okay, I have one slide on post-closing and repayment and asset management. LISC, you will be receiving your invoices, which are emailed to you or mailed to you on the 15th, and the payments are due on the 1st of the month. There is a treasury department that works to disperse loans. Many of our loans are construction loans that disperse over a period of time, so you will be working with your asset manager and with your local relationship program officer to put in draw requests as needed for loan disbursement. Beyond that, your asset manager will be reaching out to you periodically to get updates on the project, to understand, whether it's proceeding on track, if, you have to change certain funding sources for the next phase of financing, and also to gather financial information on an annual basis. We do, our auditors require us to report on our loans annually and review them, and we are audited by government agencies, by S&P, so there's a bunch of scrutiny on our portfolio, and we work with the borrowers as much as we can to gather the information that we need. So you will be assigned an asset manager who's your point of contact, and you have questions about invoices and such, you can reach out to them.
Well, thank you. So thank you, Connie, Malini, Noam, and Alex. We now have time for questions, so let's get back to some of those questions that we couldn't address along the way. Bear with me a second. One question was about the 10% equity requirement for profit.
So for for-profit borrowers, we would expect 10% equity contribution from them for whatever stage of development we're in, 10% of the total sources of that stage of development. For a nonprofit borrower, we would expect 5% equity.
Okay, thank you for that clarification.
If you want to put more in, that's fine too.
Minimum. Yes.
Yeah. Kind of small nonprofit currently with under $200,000 budget, and currently renting space in the building, but desires to create a community center. Would they be eligible?
Potentially, yeah. So we see throughout the year in our loan portfolio a rent replacement strategy where an organization, it really depends on, if you're paying $2,000 a month in rent and you can buy a building that's $1,500 a month, all in taxes and whatnot, we will, take a look at those opportunities. We are supportive of that. If you're, working in a neighborhood that's really important to one of our local offices, if you're revitalizing that community, that's all part of our mission, and we will support that. So absolutely talk to your local program officer if you have that sort of project.
Right, and as we have specific questions here and more general ones, I'll ask about the more general questions and ask that the specific situations and specific cases that Connie said, please reach, and others have said, please reach out to your local office, to your rural program representative. If you don't know who to reach out to national, and we could either address the questions ourselves or refer you to somebody in a local office who can help you with these very good and specific questions. Something along the lines of a more general question is whether we have a streamlined product such as a $100,000 or less loan, and how that's addressed.
Yes, we do. We do have a small business product that is from $25,000 to $100,000 for working capital, equipment purchases. Really, these are for growing businesses that are looking to expand or move out of their home-based business and start in a different facility. So yes, we do. It goes through a quicker process in terms of the underwriting and credit.
Thank you. Another question is, could we describe the Capital Magnet Fund?
Yeah, the Capital Magnet Fund is a grant that LISC applies for from the CDFI Fund. It is monies that support projects that basically finance very low-income housing. So the 30% AMI and 50% AMI is primarily what that grant money likes to target. It's a specific government source, and so there's compliance that comes with it. But it does help us. We've received 3 awards of Capital Magnet, and we are allowed to put it into rental housing projects, and it does help in specifically for supportive housing because they are very low income, target very low income individuals.
And it's geographically restricted. The resources we have, when we apply, we're allowed to, target 10 states, and so we do have geographic restrictions on that. So please do, reach out to us. LISC's website does have links to all of our local offices, so you can take a look and try to find your local office and see what they're up to, you can just email us directly and we'll give you a contact if you have a project.
And then there were a few questions also about guarantees. One was in lending to co-ops and in lending to co-ops.
How do we deal with the
Yes.
guarantees? If it's
Yeah. How do we address personal guarantees? And another question was for-profit developers and tax credit transactions. What would you still require personal guarantees?
You would.
Yeah.
No, it's really tough.
Well, our policy is that every principal owner of the borrowing entity must guarantee the loan. They're joint and several guarantees. We underwrite principals that own more than 20% stake in the borrower. So that's our general policy. We do make exceptions from time to time. For example, if there's sort of the silent group of investors that don't typically guarantee. But we mitigate that with making sure that the other guarantors have sufficient liquidity and a personal net worth for us to not put you a full guarantee from every entity within the borrower. So we do make certain exceptions. Unlike a project, it depends on the stage of financing. If we're coming in as a permanent financing stage, we don't typically require a guarantee because the project's gone beyond some of the more risky phases of development. So we can get comfortable without guarantees in the permanent phase. But in the early stages of financing, such as pre-development and acquisition and construction, we do require guarantees. Again, there's flexibility in how we structure it. We could have guarantees that burn off once certain risks parts of the development are complete. We do sometimes ask for letters of credit that we can release. So there is a level of flexibility. It just depends on the project and finance.
And generally, if we're being flexible, we're looking for some mitigant, as Malini has highlighted. If there's some request for us to give on our standard guidelines, there's usually some generally much stronger impetus to encourage us to do that.
So two last questions real quick, and then I'll wrap up. Keeping in mind, of course, that these questions and that we don't get to will be addressed after the seminar, and so don't feel as though any unanswered questions in this hour will go unanswered long term. They will not. But real quick, someone asked about the checklist. Will it be available in a handout form? We will be able to get it to you.
Yeah.
I'm not sure if it'll be on the website or if it'll be emailed to you or if we contact you rep, but we can get it to you very easily.
Yeah,
Put it on the website. The next question is about, do we have projects in LISC Lending history working directly with municipal housing, resident advisory boards, or affordable housing?
Yes.
Okay.
I saw one other question. Someone was asking about our delinquency and performance. LISC, as we noted, is AA negative investment grade rated. That's because we have a long, successful track record. Our delinquencies tend to be 2% or less. That's what we work towards, and we've been fortunate to be able to see that performance level for the last half a dozen years or longer. If there's a potential investor who's listening in, we're happy to give you a pitch deck of kind of our performance, our history, our financial makeup, and any additional questions you might have.
And finally, I'd like to wrap up with a comment which I'm sure today's presenters will agree with, as well as other people in the room, which is there are many great things about working at LISC, but I think what excites us most are your projects, your businesses, and the ability that we can have to play a meaningful role in the work that you do to strengthen your communities and improve the lives of their residents. We sincerely thank our funders and supporters for enabling us to make the loans we do, and for our current borrowers, future borrowers, we look forward to working with you on your next project, your next financing, and the one after that, and the one after that. So thank you very much, and have a good day.
Thanks, Alex. Don't close it because I think you need to stop the recording.